Thanks a lot, and very good morning to all of you, and thanks Marine Money to giving Standard Chartered Bank yet another opportunity to present its view in front of such an esteemed audience. Now, as introduced by Andrew, we are going to talk about the outlook on global trade over the next few quarters, and you can clearly see the title is Reverberations. It pretty much says the state we stand today. Before we delve into how 2025 is likely to look like, it's extremely important to see how global trade has panned out over last few quarters. As you can very clearly see that overall, both goods and services trades have been doing well in 2024. Effectively, it added $1 trillion in 2024 with equal contribution by both goods and trade, goods and services. Goods trade in value as well as in volume, as you can see in the second slide. Both grew, but it's pretty evident from the first chart that the volume growth in goods trade has not been as stellar as services. Services growth has been doing much better than goods. If you look at it on a regional basis, developing countries, and I would rather focus on annual rather than simply looking at the last quarter. On an annual basis, developing countries' trade in value terms has done much better than developed markets. Though one has to acknowledge that in the last quarter of 2024, based on UNCTAD estimates, developed world trade was picking up much better than the developing economies. In 2025, our view is that global growth is likely to remain pretty similar to what it was in 2024. But that starts with a basic assumption that we are not hit by trade shocks. And there is a fair bit of uncertainty about the level of tariffs which will be imposed on each and every country. And there is a fair bit of uncertainty around the geopolitical tensions which make our global growth outlook as well as how trade would pan out. There are the risks of uncertainties, the band of uncertainty around our baseline scenario is quite wide in 2025. Now, if I have to look at, from this audience perspective, we'll only focus on the tariff related risks to global trade. Most of you would be aware that there are two tariff risks which we are talking about. One is universal, that is anything which is entering US from anywhere in the world gets tariffed at the same rate, whether it is 10% or 20%. And the second risk is around reciprocal, that is US will charge every economy the same tariff which the other country charges US. So if India is charging 15%, India will also get charged at 15%. Reciprocal tariff is the flavor of the season, I would say since last week, as President Trump has described it as a beautiful and a simple system, but is definitely likely to create a lot of stir in rest of the world. While tariff gap between US and each economy will be the guiding tool, the most important driver of how tariff or the trade policies of US with each country gets shaped up, in our view, would very crucially depend on the size of trade surplus each country runs with US. And this chart says it all. China runs a massive trade surplus, and so does EU. Within EU, you can clearly see Germany is the most exposed. In ASEAN economies, Vietnam has a massive exposure or runs a massive trade surplus with US, and therefore it's likely to be hit more than the other ASEAN economies. In LATAM, as well known to most of you, Mexico is at significant risk when you are looking at that region. India is also at risk. If you see the small bar almost to the left-hand side, India is also at risk because it runs a trade surplus of close trade surplus with US, but relative to China, or any other country, the size of trade surplus is almost 1/5 or 1/6 or 1/4 of what is the case for China, European Union or Mexico. So risks are there, but not as large as for other countries. Based on the chart which I just showed, we'll first focus on China. For China, and if I stay with the theme of reciprocal tariff, since President Trump has come to office, he has been announcing slew of tariff increases. And based on the latest tariff impositions, China today has a tariff rate, effective tariff rate, or is Chinese good entering US is been charged at more than 20%, while in case of US, when US is importing it is charging actually, China's tariff rate is now at 20%. So effectively, US is now getting a better deal when it comes to reciprocal. China is charging them a lesser tariff than what US is charging them. Ideally, even in the world of reciprocal tariff, this should mean an end of risks for China. But that's not the case for a host of reasons, as we all know. China has been threatened with a 60% tariff. We don't think we will see 60% tariff rate being imposed on China by the US, but there will be a more nuanced approach going forward. Effectively, wherever US can substitute from other countries vis-a-vis China, those segments are likely to be hit more versus where there is absolutely no option of substituting into some other country. The other risk which China is facing or is going to face more going forward is towards rerouting. President Trump has talked about stricter rules of origination. As you can see in the chart which is on your left-hand side, US and China trade has come off significantly, especially since Trump 1.0. But at the same time, China has been rerouting a lot of its exports to US via Mexico and via Vietnam. This segment will be under radar, and we are likely to see more action on this front to discourage, or the implementation or the monitoring will be far more stricter. Our calculation is that if 10% tariff is hit on China, which is not the case for the rest of the world, then China's growth can be hit by almost 100 basis points. So if China is growing at 4.5%, it can start growing at 3.5% if additional 10% tariff is imposed. But we do expect a lot more negotiations to happen. But all said and done, growth is likely to be adversely impacted. And it will have reverberations around the world, because if you see in the right-hand side chart, a lot of countries, right from Asian countries like Japan, European economies like Germany, a lot of countries today derive higher proportion of final demand from China than they do from US. While Mexico and Canada are exceptions, but a lot of countries have very high dependency on China vis-a-vis US, and any tariff restrictions on China will have impact across the world. This is a repeat of the chart which I already showed, but here I would like to focus on EU, because it's a very big bloc, and it is under the under US radar when it comes to trade and tariff related issues. US is the biggest trade partner for EU. It is the biggest trade partner. The problem is that EU exports 50% more to US than what it imports from US. So that really puts it in a tough environment. Unlike China, which has reduced its dependency on net exports to drive its growth, Europe growth has been, to a great extent, being driven by higher and higher net exports, including net exports to the US. So any tariff escalation, any trade war between US and Europe is likely to impact EU a lot more going forward. We do believe that EU has, in fact, if you look at the comments, EU has already highlighted that they are ready for negotiations. They have offered to import a lot more LNG from US, and we do think that they will go and allow for more concessions when it comes to auto or the chemical or heavy engineering sector. We do think there is a lot more negotiation which is likely to happen to keep US in a better place. But before we reach that point, they will, the path to that agreement is unlikely to be very smooth, especially after the Munich conference, which happened over the weekend, and where geopolitical tensions around Ukraine is something which will keep the EU policymakers also on a slightly on the edge. In a nutshell, the risk of a retaliatory tariff from EU, but in a big picture or a medium-term perspective, we do think that both US and Europe will reach an agreement and move beyond this phase of uncertainty. Now, no war comes without a winner or a loser. So, suppose if China actually sees a tariff increase all the way to 60%, our sense is that countries like Mexico and Vietnam are likely to be big beneficiaries. India is also likely to benefit, but not as large as what we think Mexico, Vietnam and Canada would. One can counter-argue that Mexico and Canada were the first set of economies to be hit by tariffs after Trump came to power. So what gives us this, of course these are calculations, but what still makes this a highly probable scenario is that Mexico and Canada's proximity to US plus support of US corporates towards having these trade channels pretty open. And the other important part is also about the growing influence of China in the LATAM economies. The left-hand side chart, if you focus on, China has been investing at a much faster pace in terms of FDI in LATAM economies. While the stock of FDI in LATAM from China is still significantly lower than US, the last thing which US would want is to have an increasing influence of China right in its backyard. So our sense is, this theme will play out, if obviously not in the same proportion, but they are likely to be big beneficiaries along with, even Vietnam. What about the Indian economy? I mean, if we simply go by the thumb rule of tariff gap, on the right-hand side you can see that sectors like agriculture, textile, even auto are at most risk. But our sense is that the government is unlikely to throw open these labor-intensive sectors for free trade from US. So there will be more negotiations. As already highlighted by the previous speaker, in the budget, the finance minister has already reduced import duties on a lot of auto components. So if you see transportation, there is a big gap. The process has already started. Yesterday, the finance minister highlighted that the import duty will be further reduced. India has already offered to get more LNG from US. So our sense is this will be an ongoing negotiation, and we are likely to see, a middle path being reached between India and US. The risk which we need to keep an eye, especially from India's perspective, is not the goods trade. Our sense is the maximum hit, it could be, the price tag won't be more than $8 to $10 billion, which is not significant if you are talking about an economy which is going to become a $4 trillion economy in next few months. The risk is around services or the digital services, and that is a risk worth watching, both from China's perspective, India, as well as EU perspective. We talked about tariff risks. Please keep an eye on the non-tariff barriers, which have come into, which are getting discussed a lot since last week. Non-tariff barriers includes FX policy, so if I'm keeping exchange rate at a particular level, VAT, value-added tax, which is imposed by every country, or subsidies which the government provides. Now, effectively, if you see, it's not discriminatory, but there is a view coming out of the US that the non-tariff barriers are putting US goods at a more, they're making US goods more non-competitive. If you just look at it, I mean, India really stands out, and the gap can be just 25%, but same as with Korea, it really stands out. So how this whole non-tariff barrier discussion shapes up will be extremely important. US has asked its Department of Commerce to prepare country by country, product by product plan for each trade partner by April 1st. So April 2nd will be extremely interesting to watch out for, though it is equally important to know that implementing non-tariff barrier won't be easy. Trump has already introduced the new Reciprocal Trade Act. It was not passed during his first term. So can he just go ahead with these without having the Congress approval? Can he really prove unfair trade practices for each of the trade partner? Will US go and reduce its tariff if the counterparty or the counter country is actually imposing high tariff? These are some big questions which we'll have to watch out for in terms of assessing the risks on growth as well as on trade. Very quickly, US policy on allowing more drilling. Till now, it has not shown any sharp increases in number of rig counts, but this is a space worth watching, especially if you are looking at it from the trade perspective. Geopolitics, I clearly highlighted. This will shape the tone and the texture of trade negotiations. This can delay or accelerate trade negotiations. So this is something else which we'll need to keep a close eye on. This is a very quick summary. And the last column is something which you can, because this includes the impact on various countries. India is not here, but it is moderately negative for India. How trade policies, immigration policies, FX monetary, every single part, how it impacts each economy. And you can clearly see Mexico, which is in the last block, is in the red. The rest of the other countries are mostly in the moderately negative. But net-net, this will be an interesting year on how these trade negotiations shape up. We have talked about a lot of negatives, the risks, but nothing comes without a silver lining. It is, if we look at it from US perspective, they would like to have a sticking contract with the rest of the world. They don't want a sticking plaster. So our sense is there will be a middle path which will be struck between the US and rest of the world when it comes to tariff gaps. US is talking about deregulation. As you can see in this chart, US productivity gains have been massive. And if there is further deregulation, you can see further productivity improvements. And if a $30 trillion economy grows strongly, it takes all the boats higher along with itself. Even in case of India, there is a lot more emphasis on deregulation. China, the big thing to talk about is DeepSeek. Can they really make AI far more cheaper for the rest of the world to adopt in order to keep themselves relevant? EU, they have, their decision-making process requires approvals at different levels, but will they now accelerate it to bring structural strength from within? So these are a few positives which can also come, and therefore, it's important to keep an eye on the risk, but it's equally important in our view to keep an eye on what the positives outcome can be if the phase of uncertainty remains for much longer. Thank you. With that, I'll bring an end to this presentation. Thank you.